Welcome everyone to our performance snapshot for the HFRX in mid-January. With us today is President of HFR Index, Ken Hines. Welcome back, Ken.
Thanks, Anika.
So Ken, before we dive in, do you want to give us an overview of the first 2 weeks of the year?
Yeah, I think the year's off to an interesting start. We've seen market movements, positive and negative, in both the equity and bond market. There was a lot of concern in the first couple of weeks of the year about interest rates rising, or I would guess to say not as many interest rate cuts as people expected, had priced in late last year. And as a result of that, we saw bond yields climbing and some pressure on equities, particularly growth-oriented equities. But in the most recent weeks, some of those fears abated. The inflation data from this week was, I think, good, and we've seen that process normalize. And so through that, we've seen good hedge fund performance to start the year, which is exciting, picking up wherever they left off from a strong year in 2024. So we can talk about the leading areas of strategy and sub-strategy performance as we make it through this first month of the year. You can see here, and obviously here we are preparing for the new administration to be sworn in here in Monday of this month, or of next week. You can see that the leading area has been the market directional index, which is pretty much in line with equity hedge. Both of them up about 0.7%. Good performance. You can see large cap equities had a gain of about 1 1/3%. Really, a lot of that was the entire gain was just a couple of days ago when we got the economic data, the CPI data that showed softer inflation, put the idea of interest rate cuts back on the table, and most of the gain for equities really happened in one day so far. And then you can see here 1/3% gain for the overall composite, that pretty much in line with where event-driven is, about 1/3% gain there. Small gain for fixed income-based relative value arbitrage. We know rates have had kind of a choppy path in the first couple of weeks of the month, with a lot of pressure earlier and some of that abating in the last few days. And then the macro CTA index actually shows a decline, not a huge, about 0.5%. You recall that in December, that was actually that was the leading area of strategy performance in December, when we actually saw equities fall and bond yields rise.
Definitely. So if we look at the sub-strategy level in the first couple of weeks of the year, what stands out?
Yeah, you can see here growth equities, fundamental growth, HFRX, really the leading area. That actually tops what the large cap equities did in the first couple of weeks of the month. Again, 1.6%. Really, a lot of that gain earlier this week when we did have that CPI data and the big move upward in equities. 1.2% for the HFRX Merger Arb Index, which is interesting because, as you know, with the incoming administration, there's a lot of expectation for an improved environment for M&A, looking into the year, lighter regulation, and just a more business-friendly policies across a lot of different areas. And so, not surprising to see a good beginning to the year for Merger Arb, and hopeful to see that continue. You can see special situations is also on the list of the top performing sub-strategies. And again, it's early, it's only 2 weeks in. And then you also have market neutral and fundamental value as the leading sub-strategy areas for the first couple weeks of the year.
So I guess since it is just 2 months in, how about we compare or look at performance as an average over the last 12 months? What patterns stand out to you?
Yeah, we actually just want to obviously look at January really with a longer lens of time to see how all the strategies have done in the last year. So this is really 12 months and a half a month, what we're looking at here. And really the last 2 weeks haven't changed it all that much. You can see leading area for 24 was equity hedge. That's still the leading area when we add January to it. a gain of about 8.75% there, which is good. 8.5% for the HFRX market directional, which is good. It's a little bit more of a concentrated index and a little higher volatility index than what we have for the global. You can see the global is next at 5.6%, 5.1% for fixed income based relative value arbitrage. We know we've talked about the choppy path interest rates have followed not only in January, but really in the last year, and how that has been a very steady performing index. We've talked about that in other videos as well. Event driven, we talked about that earlier, a gain of 4%. And again, I think that's stronger. It was stronger in the second half of 2024 than what it began the year. So looking ahead, I think there's a lot of a high expectation, a lot of enthusiasm for event-driven performance looking into the year. And then finally, macro CTA, which had a volatile 2024. It started off very strong, kind of the opposite of event-driven. Different, gains and loss, kind of oscillated between gains and losses throughout the year. In the latter half of 2024, where there was a lot of speculation on interest rates and the geopolitical uncertainty associated with the election, a lot of that obviously much more clear now than what it was a short time ago.
Okay. And at the sub-strategy level over the last 12 months, how have we done?
Yeah, again, a similar story here. Fundamental growth, the leading area of sub-strategy performance, 11.1%. You can see there, a little better than 8% for market neutral. What's really exciting is, market neutral is categorically, targeting very low or even zero net exposure from a beta standpoint. So when you typically see market neutral doing well is when you see after a period of sort of dislocation where you see a very wide dispersion or deviation of equity prices from their normal relationships, you see those things converge and mean revert. That's when market neutral does very well. And so I guess we can say we saw that at different points in the year 2024, and a little better than 8% gain, 7.6% in fundamental value. And again, a lot of those deep values are large cap, sort of the non-technology area of the market, where you may have financials and things like that, consumer oriented or energy stocks can fall into that fundamental value bucket. Convertible arbitrage there, you have positive exposure to volatility, short equities and long bond trades, and obviously long from a yield perspective as well. A gain of just under 7% for the rolling 12-month period. And then finally, relative value multi-strategy, which includes funds kind of like convertible arbitrage, but even more generally, fixed income arbitrage, capital structure arbitrage, things like that. A gain of just under 5% the last year and 2 weeks.
Well, thank you, Ken, for that snapshot. And before we wrap up, anything else you'd like to add?
Yeah, well, we encourage everybody to visit the new website that we just got up a couple months ago, www.hfr.com. When you do visit that, please check out and download the Investor Guidebook. It's a great resource that we've put together that really speaks to a lot of the use case and the utility of all of the families of investable indices that HFR publishes. If you'd like to set up a call with me, Ken Hines, you can reach me by send an email directly or send an email to indices@hfr.com, discuss anything you see on the website or in the Investor Guidebook, or you can certainly reach out to any other representative you work with at HFR. And if you're watching this video, we do regular performance updates on our YouTube channel. Please subscribe to the channel and feel free to submit any questions on things that you have heard on this video, things you'd like us to discuss on future videos in greater detail. Happy to do that. Happy New Year, and we'll speak with you again in a couple weeks.
Thank you so much, Ken.
Thanks.